Hi, thanks for joining us. We're here to present the Affordable Home Mortgage Program. I do work with a broker, and we have a great relationship with a bank that is offering this program. And what this program is a special grant that gives up to $25,000 to be applied towards closing costs with no increase to the rate, payment, or points. If anything, it does the adverse effect where it will lower your payment by paying down points with this money. And we'll go into that here in more detail. This grant, up to $25,000, can help the borrower pay loan-related fees and closing costs on a conforming FHA and Fannie Mae HomeReady home loan. So this $25,000 may be applied towards lender closing costs, third-party fees and settlement costs, and points to buy down the rate. Now, if you have an FHA mortgage, you can also use it to pay off the upfront mortgage cost. There is a caveat on this, so stay tuned, and I'll touch on that in a bit once we go over the FHA, talk a little bit more about FHA, the program. So the requirements are this is only available on conforming loans, FHA, and Fannie Mae Home Ready programs. So on conforming loans, we are using the DU or Fannie Mae guidelines. So this will not accept LP or Freddie Mac. FHA loans, of course, are going to use FHA guidelines. And Fannie Mae Home Ready program, if you haven't guessed, we're going to be using Fannie Mae guidelines on that as well. Now, if you're not aware of the Home Ready program, this is mostly a first-time home buyer program, also at more moderate income levels. So they do have income restrictions on this, and we'll go over that more once we further into the presentation here. Now, this program is only for Southern California counties, and uh, which include Ventura, Los Angeles, San Bernardino, Riverside, Orange, and San Diego, and available only in eligible census tracts. And we'll go over these in a bit here further on. And then, of course, there will be income restrictions on this. Some of this will be a little bit more redundant, but it will reiterate the points of what's important in this program. Also, we'll give throughout more and more details of what restrictions or what's allowed on there. So what is this program? The AHMP, or Affordable Home Mortgage Program. This is a lender credit up to $25,000 that can be applied towards borrowers' recurring and non-recurring closing costs. The funds do not have to be repaid, and they are not a lien. So unlike your down payment assistance programs where they will inflate the rates, which is they use the back-end money to help cover for your down payment, this is actually a grant given by the bank that we have a relationship with, that would cover as a lender credit for your closing costs. And as we use regular rate sheets and off of that for those particular loan programs, and you can use that to apply towards closing costs and even pay points to reduce your interest rates. And again, this will not need to be repaid, but you do need to meet the special guidelines and restrictions they have on this program. And we'll go over that. So the guidelines. Only single family, condos, PUDs, and primary residence of 2 to 4 units at a reduced what they call loan to value. And what loan to value means is LTVs are loan to value. What that means is amount financed. So if you start off at 100%, 100% LTV means it's 100% finance. But if you are somebody who is buying, put 10% down, then you have a 90% LTV. And that's kind of how you determine what an LTV is. So these are only eligible for these separate properties, and then you use this to purchase the property. You can refinance. So if you are already living in the home and want to refinance and get a lower rate, you can do that. Or if you got a bunch of equity, you want to take money out and do things like home improvement, debt consolidation, whatever you may want to do with that money, you can do that as well. This will also qualify. Now, the home buyer or person must live in this property as a primary residence and owner occupied. So you have to be living there. You cannot use this as a investment property, or nor can you use this as a secondary home or vacation home. So this is again reiterated the eligible assessed counties of Los Angeles, Orange, San Bernardino, Riverside, Ventura, and San Diego. Now to touch on where those census tracts are, it can only be in areas that are 50% greater than 50% minority on the FFIEC geocoding system data, and we'll show you how to obtain that information if a property is eligible. Per FHA guidelines, the maximum interested party contributions, including H&P grant, may not exceed 6% of the sales price. So in this scenario, if you're looking to buy a property, right, and using FHA, they would use up to 6% of the sales price, with it capping at up to $25,000. So if you have a $500,000 loan or $500,000 sales price, that's $30,000, or it would be capped, which would be reduced to 25 because that is the cap. Or if you got a $300,000 home, that would be $18,000, but will be obviously less than $25,000. So that would be your maximum contribution towards your closing costs. Now, Fannie Mae HomeReady, and also this meets with conforming, has a maximum third-party contributions based on the LTV. So if you have 90% or greater, you're capped at 3% of the sales price. If you're at between 75 and 90%, that limit is 6%. Now, 75% or less is at 9%, but most likely you're going to be in the 3 to 6% range, probably because if you're at 9%, you'll probably exceed the 25% range anyways, as that illustration with the loan amounts that we see here in Southern California. Now, let's look ahead here. So they do have some terms and restrictions. This grant cannot be combined with the Community Plus and Community Premier pricing incentive. So this is a special pricing incentive that they do offer on some of these on their programs on there. So this cannot be combined. It's available again only on conforming FHA and Fannie Mae HomeReady programs. It cannot be combined with any other home loan programs. So it cannot be combined with their jumbo loans or anything else. Now, on this, the conforming and Fannie Mae HomeReady, they only go up to regular conforming limits. So they do not allow the high balance. They do not have high balance for those. However, the FHA does go up to high balance limits. So you can use FHA up to those on those. All proceeds of this offer must go towards loan-related closing costs and fees. So anything left over will not, it'll basically just go away. It'll go back to the bank. So if you do not use all the funds, it goes back to the bank, and will not be able, you won't be, again, it won't be applied towards your cash back to you, or it will not be even to buy it on your balance. A down payment must be borrower paid as required by conforming FHA and Fannie Mae guidelines. So again, this is not a down payment program. This is only a lender credit towards closing costs. So if you're buying, you need to have the down payment available to make the property. This offer expires when funds have been exhausted. So what this is the bank allocated money into an account for this to happen. So they want to be able to have loans in minority areas and help out those areas, and help people become homeowners. And so they did start off, I believe, around 4 or 5 million is what I've heard, and then they actually added money to it. However, it doesn't mean that's going to continue. So once that money is gone, it's been earmarked for it. Once that money's gone, it could be the end of the program, or they may institute more money, add more money to it, and continue it. So again, we can't guarantee this will continue once that money is exhausted. This is something I believe they're trying to protect themselves on, and I'll touch base on it, but they did state all or a portion of the $25,000 offer may be reported to the IRS, and are borrower responsible for any federal, state, or local taxes. I have, in 20 years of doing this, I have never seen anyone pay taxes on any lender credit, because again, this is set up as a lender credit. I've never seen anyone pay taxes on. If anything, I've seen is even though on a seller credit situation, when they use that to pay their points, they've been able to write that off, even though they did not pay that themselves. They're able to write off points on their tax returns. But again, I'm not a certified tax consultant, so you're best to talk to your personal tax accountant to see if there might be any tax liabilities on your end. So again, I'm not a tax person, but I'm just reporting what I've seen over the last 20 years of doing loans. And again, talk to your tax person on that. The customer cannot keep any portion of this offer outside of the loan transaction. As we kind of stated, the money goes back to the bank if all of it's not used. All loans are subject to underwriter approval. Like any other mortgage, underwriter does have to underwrite it and approve it. and the property must be in a census tract that is greater than 50% minority. We'll touch on that. We'll show you how to find that out. Uh, and borrower must meet program income guidelines. So there are some income guidelines on this, and we'll go over that in a bit as well. So here's the eligible tracts and how to find it. It's on this website here, GeoMap FFIEC Government, and I will put a link below for your reference. You can click on it, you can type in it. I highly recommend checking it out because you'll be amazed of all the different communities that properties are available on. And so again, I highly recommend checking it out. So once you get to the website, you'll want to enter the property address, click on the most recent year. I don't believe they've added the 23 data yet, so you'll want to use the 2022 data, and then click on the census demographic data, and then you'll look up the tract minority. So here's an illustration of what this page will look like. Address here is just a random address we just grabbed and for illustration purposes, so please don't read into it. So again, we use the 2022 year. We typed in the address. We got this here, so we got the census demographic data. We'll click on this, and you'll find the tract minority percentage right here. So on this illustration, it came to 92.83%, which will qualify. Here's our loan limits we were talking about. We are using only regular conforming limits for Fannie Mae HomeReady loan and conforming. So these are now up. They just did this in February. They increased the limits. They were up to 22, and in February they implemented the 2023 loan limits. So a single unit will go up to 726,200, and then and of course you got 2, 3, and 4 units. Now on FHA, it's based on the county loan limits. In Los Angeles, with a high balance, it goes up to $1,089,300. Same thing in Orange County. And of course, it would go to the 1 unit, 2 unit, 3 unit, and 4 unit. So kind of like here, it's the same thing, 1, 2, 3, and 4 units here, residential. And of course, these are the county limits for the rest of them. So Riverside, San Bernardino, as you see, are at 644,000. Of course, San Diego and Ventura are different as well. So you can find this information. Income limits. Here's where we're touching base on that. And income limits are based on number of occupants in a household. So for households over 4 units, we just cap it at 4 people. So if you have 4, like 5 or 6 people in your household, we'll use the 4 person in that scenario. So LA County, single person is only at 91,100. So the total household cannot make more than 91,100 to qualify. However, in Orange County, you can go up to 119,100. But if you're in San Bernardino or Riverside, it's even lower than LA at 87,400. This is for a single person, as you can see here. However, if you're married and have another spouse, that would be a 2-person. Or if you have kids, or maybe even parents that might be living with you and claim on its deduction on there, any limit on there, you can find right here. So you can go up to 4-person up here. And of course, that would greatly increase your income limits to qualify. Now, how do you find the income limits for Fannie Mae HomeReady program? Well, HomeReady, again, does have in itself the guidelines to require up to 80% median of the average median for that census tract. So in this scenario, you'd want to look at, go on to Fannie Mae HomeReady's website, and they give you a loan income lookup tool to determine the income for it. And here's the website right here for your reference. So again, we use a random address here, and so in this scenario, with this address at 80% of the AMI, and you'll see that kind of highlighted right here, it comes to 66,640 to follow up to be able to qualify for the HomeReady program here. So how will we apply the grant funds? First of all, there'll be you'll need to pay off the lender fees, escrow, title, any prepaids, and the appraisal. So once those are paid off, we'll go down to buying the rate down. Which means you're paying the points to reduce your rate. You can apply your own funds if you want to lower your rate as well. However, for the general fund here, we need these first 2. Now on the third one, this is only applicable for FHA loans. Funds can be applied towards the full payment of upfront mortgage insurance. So if you could do one of two things. You could pay off the entire mortgage, upfront mortgage insurance, or you could basically finance that mortgage loan in there. Now, the thing on this is that if you don't have enough in a grant to pay off your full mortgage insurance, uh, it has to be full or there's no partial payment. So you can't just pay part of it with the grant. You have to pay the whole thing off. So otherwise, it will not be included with it. So you'd be better off if you don't have enough to cover the full MIP. You want to just use that to buy the points, reduce it, and just finance that back into it. So as you can see here, the grant cannot be applied towards the minimum down payment required by conforming FHA and Fannie Mae guidelines. Again, I think we've already touched on that, that you have to have your minimum down payment on this, as this is not a down payment program. It is just money to be applied towards closing costs. So the breakdown of costs, these are some illustrations we're looking at. So here's an example of a FHA loan that covers all the closing costs. So in this scenario, we have a family of 3 purchasing a home in Norwalk, California. The annual household income is $112,563. They're looking at a purchase price of $483,000 or $485,000. Excuse me. Down payment at 3.5% is $16,975. Of course, that is from the buyer; they are paying that themselves. So again, these aren't today's rates. This is kind of older, as you can tell. So today's rate was at 3% with a cost of 0.793 points, or $3,711.44. So this is how the breakdown comes. So our closing estimate would be $9,558.98. So this would be applied from the grant money to apply for that first, and then second, you could pay the points. So in this scenario, we have the $3,711.44. You can buy that down. On FHA, upfront MIP would be $8,190.44. So your total on this would be $21,460.86. That covers this fits underneath the $25,000. So this will cover all closing costs, as you can see here. So this will cover the recurring and non-recurring, the costs to lower the rate, and the full amount of the upfront MIP. So here's the illustration that it does not cover the upfront MIP. Here's a family of 4 buying a home in Anaheim, California, with an annual income of $180,000. The purchase price is $752,000. The down payment is 3.5%, or $26,320, which of course the borrower needs to come in with that money. We'll use for illustration points, we'll use 3.25 rate at 0.945 in points. That it comes to $6,970.68. Closing costs on this, which will be the first one to be paid off, estimate comes to $11,432. And of course, the rate, the points comes to $6,977.68. And then you got upfront mortgage insurance, which is $12,699.40. So we had the full $25,000 on this. However, as you can see here, total closing cost comes to $18,409.68. It's not enough to cover the $12,000 added to that. So we had $11,000 and almost $7,000 here. So it brings us to about $18,000. So if we add the upfront MIP, it's not gonna work. It's not gonna be covered because it's less than $25,000 here. So borrower received $18,409.68 from the grant. This amount covers total closing costs and costs to lower the rate. The grant doesn't cover upfront MIP in this case, since the grant must pay the entire or none of the upfront MIP. So hopefully this will make sense for you folks. Okay, grant may not be used for the following. We'll have a number of items here, so pay attention. The borrower's minimum required investment, so that's your down payment. So you have to have the money for your down payment if you're buying. The grant cannot be used for a program required reserves if applicable. So let's say, for example, FHA doesn't typically require reserves, but Fannie Mae will require it. Sometimes they will require about 2 months of housing payment in reserves. So this cannot be applied towards any of those reserves, as it's not cash or anything. So you need to be able to show that. A grant cannot be used to reduce the principal balance if the credit amount exceeds the actual dollar amount for closing costs and prepaid expenses. So like I said before, if there's anything left over, it cannot be used to reduce your balance. It will just go back to the bank. May not be used for payments of debts, collection accounts, escrow shortages, or missed mortgage payments or judgments. So if you have any derogatory on there, this cannot be used to fix that. Again, this is as a credit to be applied. You'll need to kind of take care of that yourself. Non-realty or personal property. Non-realty or personal property chattel that the borrower agrees to pay for separately, including the amount subtracted from the sales price, when determining the maximum mortgage are included in the total cash requirements. So this is kind of a situation where if you're buying a house and you want the seller to leave in certain items that doesn't typically come with the house, and you want that covered, this cannot be as part of that. So this cannot cover those items there. So you'll basically need to subtract that out of the sales price, what those are for that to qualify. Real estate agent fees. If a borrower is represented by a real estate agency and must pay any fee directly to the agent, that expense must be included in the total borrower's settlement requirements. Repairs and improvements. Repairs and improvements or any portion paid by the borrower that cannot be financed into the mortgage are part of the borrower's total cash requirements. Condos, seller HOA arrears. So if there's any HOA in arrears by the seller, this cannot be applied towards that as well. New condo projects are not eligible. So if it's a brand new condo looking for people, most likely it's not Fannie Mae yet approved, so it's not going to, or even FHA approved, so most likely it's not going to be eligible. Realtor transaction coordination fees may not exceed the typical fee charged by a realtor due to grant. So a realtor can't try to inflate their fees on something like this. It's covered. It has to be your typical fee covered. FHA loans. Grant may not be used to make partial payment of upfront MIP. It must be entire or none, as we talked about before. The grant may not be used to pay any realtor commissions. And then, of course, lastly, seller, state, or local transfer taxes. So this cannot be applied towards transfer taxes. So if you want any more information on this, or if you're ready to begin, please feel free to reach out. Here's my contact information. We appreciate your time taking to watch this video.